Hi there, welcome to Alternative Investing. I'm Andrew Bell. Here, of course, my regular Friday co-host, David Kaufman, President, Westcourt Capital. Great to see you once again.
Pleasure to be here.
On this show, we explore investment concepts outside of the traditional realms of stocks and bonds. It's for investors like you, maybe sitting on cash, looking for alternative places to put your money, places not in the public markets, but in funds or products that fly a little more under the radar. On today's show, we are talking about insurance. People think of insurance as protection for the families, homes, businesses, but insurance can also be another tool for investors to build wealth. David, explain this. It's not just about protecting yourself?
No, that's right. Most people, of course, when they think about insurance, they think about what is term insurance. And what you're doing is you're insuring yourself against something that you hope doesn't happen and may not happen.
Dying prematurely, in other words.
Yeah, so dying prematurely, fire, flood, accidents, and you buy the insurance for a period of time when you're going to live in a house or when your kids are still in school or whatever the case may be, so that if the thing that you don't want to happen happens, that you're covered, that you can rebuild your house or you can get a new car, or that your kids can, for example, continue their education. But on the other side, you have permanent insurance, sometimes referred to as whole life insurance, which is something you don't want to happen, but is going to happen, which is eventually you will die. Mm-hmm. And it's that kind of insurance is appropriate for people who are concerned with the concept of intergenerational wealth. So they have enough money to live on, and they're thinking about what they're going to leave their heirs after they're gone. So when you look at it as an investment, because most people haven't considered the concept of insurance as an investment, think about it this way. The premiums that you pay into the insurance policy are the amount that you've invested. And the amount that comes out at the end, when you eventually die, is the payoff. And so if you look at it that way, what happens is that you can calculate how much you've put in, how long the period was in between, how much your heirs received when you die, and include the concept of taxes. Because if you were to do it not in an insurance policy, you would, for example, set up a fixed income type of investment. You'd pay real-time taxes as, for example, interest rolls in, and then you might be exposed to significant probate taxes on death. And you can take the two of them and compare, and what most people will discover, depending on their health, which is something we'll get into in a minute, they'll discover that the insurance policy provides them a better IRR, internal rate of return, which in the end, for all investing, is really what investors are after.
So we're talking basically about permanent life insurance here. Term, it just, the policy doesn't work anymore after you're 77 or something like that. There's no point getting it.
Right. You buy it for a specific period of time, typically to insure against that event. So, for example, someone who has kids that are of school age might say, I want to make sure that no matter what happens to me, that they are going to be taken care of until they're done with university. Yeah. Or that if I die and I have an outstanding mortgage, that the mortgage gets paid down, all different types of insurance. Yeah. But we're now talking about the idea about this permanent insurance that's in place to benefit the next generation.
So you die and then the policy pays off.
Exactly.
So tell us, okay, well, let's get into this. Who's this best for? Who should think about it? It's not for everybody.
No, it's not for everybody. The short answer is wealthy people that are not unhealthy. So the number one element is that it's appropriate for people that are insurable. So people that are already sick or have had a number of different health scares or concerns along the way would probably not be good candidates because their premiums would be too high. And then there's a question of having enough money or income to fund your lifestyle, as we see here, which means that you have enough other income to satisfy your sort of daily cash flow needs. Having clear estate objectives. What that means is that if you think that you might change your mind about how much you want to leave and how that's going to work, and you have an insurance policy, it's not going to give you the flexibility to change on the fly. And finally, that you have no immediate or in the near future liquidity requirements, which means that you don't decide tomorrow or next year, I'm going to buy a cottage, because guess what? The money that you're going to take for the cottage might already have been invested into your insurance policy. So you have to be able to sit down and go through that personal calculus about what your objectives are. And if you're healthy enough to get a policy at a fair price, at a premium that makes sense, then it would make sense to buy that insurance policy.
Now, typically with this type of policy, there's a payoff. You know how much the policy is going to pay off at the end. So obviously you want that to be as much as possible. So we're talking about this internal rate of return. What influences that? What pushes it up? What pushes it down?
The most important thing, of course, is are the premiums. Now, I should point out, and our guest Simon Kay will talk about this today, that some of these policies allow you to overpay, which means that you pay the premium every year, and you're allowed to pay a little bit extra, which is a pure investment. And that, too, gets sheltered from taxes while you're alive, sheltered from probate taxes after you die. But the key is that if your premium is too high, it just makes the investment less of a better bet. And so for people who are at the age where they're still young enough to be healthy enough to qualify for a premium that is a reasonable amount, that will determine whether or not this really makes sense. And so that when you take that IRR calculus, you add it up. But let's not forget about time. So the time in the IRR world is very important. It is true that the longer you live, the lower your IRR will be because you've been paying the premium over a longer period of time. However, that is a happy event for people who are still living, and so is not something that they would be overly upset about, that the IRR would be less because they live longer.
And what's risk? How does risk play into this thing?
Well, I mean, the risk that you're going to die is absolute. And so it's only a question of leave it up to the insurance company to use their algorithms to decide from an actuarial perspective how long you're expected to live. And it comes right back to the question of health. So you're a better risk for the insurance company if you're healthier in the aggregate, and you're a worse risk for the insurance company if they have some concerns about what's happened in your health history. And that, for sure, is something that we'll be talking about with our guest after the break.
Looking forward to it. Well, coming up on Alternative Investing, our conversation about insurance will continue. We'll get an expert to show us how insurance can be an alternative way to get higher returns without the volatility. Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital, and we are talking about insurance as an asset class and a vehicle for investors to build wealth. Let's learn more about the options out there for investors when it comes to insurance. Here with David and I now is Simon Kay, president of IPS Insurance. Great to have you here.
Thanks for having me.
So what do you do at IPS?
Well, I mean, in addition to the traditional role of structure and planning, we also play a significant role in the underwriting process. We feel it's probably the most significant area where we can offer impact to the overall performance of this structure of insurance as an asset class. Traditionally, this is done by the insurance company, but since it's important, you've talked in past shows about being an accredited investor. So on the insurance side, in addition to financial criteria, there's also medical criteria. So, and that can have a significant impact on the performance of this overall investment. So, we feel it's preferable to have the collection and creation of that file, of that evidence file, the medical side, to be performed independently of the insurance company. So, we do that on behalf of our clients. What that affords us is the opportunity to identify any red flags in their medical history or in their lifestyle. Maybe they have hazardous hobbies. And then we have certain interventions which we will implement to make sure that we can make sure that file is as accurate and thorough as possible. So the main role we play, like I say, is the collection and creation of that file. But then what we do is, because we now have this great opportunity of being the first to see all the evidence that has come in, we get to work with the client to now offer up a bidding process. It goes out to multiple insurers simultaneously. The medical file, exactly. The evidence file in total, and it enables us the opportunity to, like I say, have the insurers now bid for our clients. It keeps them accountable, and at the same time, it gives the client an opportunity to see a transparent approach to what the market had to offer.
Can I just, you gave us an example earlier. Say I had a mole removed years ago, and my application goes into Manulife, and there's nothing on the record that it came back negative, the test. That's going to be a red flag for Manulife. They might hike the premium, but you will go in and you'll close it off. You'll contact the doctor and assure them everything's hunky-dory.
That's exactly right.
Yeah.
So it's critical that we remove, let's say, some of the unknowns in the file, because at the end of the day, what the underwriter wants to do, and I'll put it in terms of alternative investing, they may want to add additional load for unknowns, additional premium load, which adds to your cost base. That's their hedge. So they're going to have to add something to make this financially viable for them.
Mm-hmm. So you're helping the applicant put their best foot forward, essentially. And
yes.
While you're doing that, so share with us, when the insurance company is going through the calculus of determining how risky is this person, share with us what it is that goes into that pie during that process to determine that
sure.
eventual quotient.
I think traditionally what the public believes goes into the development of that rate is some generic tombstone information. So their date of birth, what product they're purchasing, whether they're a smoker, how much insurance they're purchasing, of course. And that is only part of the story. It's that medical file, the due diligence that the insurance company needs to do, which is what determines that ultimate rate. So what we want is to boil this down to the actual real facts of the case. What is your actual accurate health profile and financial profile? What we want to avoid are these things that are unknown or things that maybe are inaccurate. And that's where we can probably play the most significant role, because we don't want the cost base of this strategy to be increased by this additional hedge by the insurance company.
Because if from the point of view of an insurance company, and they have investors too, so they have to be careful, they're saying, okay, here's what we know for sure, here's what we think we know for sure, and here's what we don't know.
That's exactly
and
right.
You've taught me this, and so you're trying to attack, what, the second two, and you're trying to create some clarity there?
So what they don't know, I'll give a couple of examples. Maybe that you have a family history of something, but you personally haven't been to the doctor in 10 or 15 years. It's actually very common. So the underwriter is sitting there saying, should I be concerned about this? Is there anything that causes me to need to put additional insurance premium on this and add to the cost base of this? So we want to be able to work directly with the client, directly with their advisors, their physician, for example, and we want to create some clarity. Use the example of a missing pathology report. We need to find the answers to that. Likewise, and to use another example, there's very often, this is very common these days, with information which is inaccurate, what they think they know. So if, for example, you were someone that just went to the gym yesterday, had a very strenuous workout, when you go and do your lab work, which is part of that due diligence process, there may be a whole bunch of the metrics of that lab work which are completely off. Your kidney function may be off, your liver function might be off, you may have high glucose levels, you may be dehydrated. So the insurer is very objective. They only have time to look at the evidence. They will take it for face value. Mm-hmm. So as far as they're concerned, you may be a complete wreck, right? So it's our job, and seeing that evidence first before it's gone to market, to be able to say with the client and work directly with their physician to say, should this be something we should be concerned about? Is there anything we can do about it to make sure that we position to put your best foot forward?
So on the one side of the equation, we have Simon K. and IPS helping me put my best foot forward. And on the other side, the reason this all works, we alluded to this before the break, is that we have these tax advantages. So it is holiday time. And can you run through sort of the gifts that Revenue Canada has put under the tree for us if we're willing to put our money in for a very long-term period of time, and how those tax advantages really work?
Sure. So to sort of lay out what the investment thesis is behind this insurance structure, really what we have is a typical scenario where, let's say, a couple would put in a defined amount of premium and prepay this structure over a very short period of time. Let's say it's 5 or 10 years as an example. And what you get are a number of these gifts, as you say. We get the immediate advantage of an increase in your estate value because you're buying insurance. Mm-hmm. You get all these surpluses of this little bank account you've created in this prepayment are actually growing on a tax-deferred basis. So at the end of the day, what's happening is you're getting the death benefit that is being paid out tax-free. And one of the great gifts is that all of that deferred gains as part of the surplus capital you put in is also being paid out on a tax-free basis. So the compounding effect of no tax and no probate is really, at the end of the day, that's the magic of this solution.
We just had a board up there. Maybe we can put it back up again, because I think it showed rates of return or what is that chart showing us?
Well, this is an example of where we have a couple, both 55 years old, that have in fact pre-funded this strategy over, let's say, a 5 or 10 year period of time. And what we've shown is, as you can see, because we have an immediate bump in the estate value, the IRR is very high, obviously, in the early years.
If they both die
If they both die early. If they, in fact, live right through to life expectancy, what that's showing is that this couple would have to have achieved, on a fully guaranteed basis for 30 or 40 years, they would have had to have achieved over 11% in their traditional investments just to keep pace with the insurance. So it's very can be very attractive.
Meanwhile, they get the policy.
Yeah.
So they have this sort of supercharged, it's like in our supercharged RSP or TFSA or registered account, which is, of course, much, much larger than something like a TFSA. And what you're saying is that you don't have to take a lot of risk within that, because the fact that it accrues tax-free, even to the heirs, means that with a moderate actual return, the pre-tax benefit of what you would have had to do otherwise is enormous.
Yeah, well, we like to think of insurance as the no-risk portion of your portfolio, and so why add risk to a no-risk product? If we're already achieving double-digit returns over that period of time with no volatility whatsoever, why would we want to add risk to that product?
How much? Now, this is obviously money that's got to be free and clear. You're not going to want to get at it for any reason. So how much, what's the minimum people would need to play in this market to put aside every year?
Well, I'm not sure that I would put a limit on it from that perspective. I would say, though, that to your point, it should be money that is not needed in your lifetime. So this is surplus assets. It's money that is already intending to go to the next generation, and it really doesn't matter whether it's $10,000 a year for 10 years or whether it's $1 million a year for 10 years. If it's money that's going to go elsewhere, and you feel as though it's a straight comparison of IRRs, and you're happy with 11-12% for the remainder of your life, then this is the strategy for you.
You see a lot more people nowadays. Warren Buffett's a good example, who says, next generation, let them fend for themselves. We'll live now.
That's my attitude.
Yeah, so for people that say, I want to benefit from some of these better ways of investing, but I want to do it for my retirement and not for my heirs when I'm long gone, is there a way that you can explain to us that that's achievable?
Yeah, absolutely. There's a number of people that use this as a retirement strategy, and really at the same time we're taking advantage of the same these same gifts that we referred to. In that situation, we're actually pre-funding a policy, but we're making it structured more on the cash value side. So we're building up this cash account, taking advantage of all that deferred growth, deferred tax growth. And what we're doing is we're structuring a loan against that cash value. You're retiring off of the loan. And then the magic of this is that you're not actually paying off the loan and the capitalized interest until death. And what happens at death? All that deferred growth and the death benefit gets paid out tax-free, and therefore you're paying off the loan with tax-free proceeds. So that can be incredibly powerful. And then when you tweak that strategy with using, for example, your personal holdco dollars, then we're really adding some additional government gifts of tax relief. By actually getting the money out of the corporation tax-free.
This can obviously get pretty complex. How many advisors out there are talking to their clients, especially their high net worth clients, about considering insurance as an asset class and using it as part of their investment horizon?
Well, certainly the advisors that are, financial advisors, lawyers, and accountants, it's been a difficult conversation over the years because no one wants to talk about their own mortality. But I think in this environment of low interest rates and the need for higher returns, for decreased volatility, and for any tax breaks, it's a conversation which is happening more and more.
We're going to have this guy back because it's really amazing, fascinating stuff.
Yeah, thank you.
Thanks
for having me.
Thanks, Simon. Simon Kay, President, IPS Insurance. Coming up, it's time to hear from you. Instead of emails today, David is going to tell us about some of the frequently asked questions he gets asked about alternative investing. Those questions and his answers are next. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital. Usually at this time we look at your emails, but today we're doing something a bit different. David, now you get asked for a lot of advice, Christmas parties, cocktail parties. Right. What are some of the typical questions people ask you about alternative investing?
The questions that I get most often surround the things that we bring up most often. So the number one thing is correlation. Right from day one in this show, we've talked about the idea that the reason that we use alternative investments is to decorrelate ourselves from the public markets. And so the question with correlation is understanding what it means and how it can help us and hurt us. So correlation, very simply, is a number between -1 and +1. And +1 means that two investments are highly correlated. It means that if you were to graph them against each other, you'd get a very similar line. Negative correlation is two things that work opposite each other. So the one thing zigs, the other thing zags. And zero correlation, which is often what we're seeking if we're looking at absolute return strategies, means that there just isn't a correlation. Sometimes they'll both go up, sometimes they'll both go down, but they don't do that because of each other, and they don't do it reliably in tandem. So what we are seeking, more often than not, if you're trying to hedge, is a negative correlation. One thing goes up, the other thing goes down. But if you're trying to just exit that asset class, we're looking for zero correlation.
It's interesting. So many people have their wealth tied up in their house, in residential real estate.
That's right.
I wonder what an asset would be that would have a negative correlation to that.
Well, first of all, I am very loath to consider the house that someone lives in as an investment. It very well may be the asset by far that is the largest asset in their net worth, but we consider investable assets because you have to live somewhere. And so the fact that your house goes up or down in value in a specific period of time is largely irrelevant unless you plan, for example, to sell and then rent. But if you're going to sell and then buy, you're going to buy in the same market that you're selling in. So I generally wouldn't even approach that as a correlation question as much as, is that part of my investment universe question?
And there's quite a lot of evidence that suggests that residential real estate is a lousy investment, especially when you include the cost of fixing the roof and all that.
That's right. The New York Times actually has spent a lot of time over the last year giving tools to investors, depending on their time horizons, to say, should I rent or should I buy? And you'd be surprised, for people that don't plan to live somewhere for more than 10 years, the answer in most urban centers is typically rent, if you can find something that you like at the right price.
Diversification, just go over that for us.
Yes, diversification is another key thing that we talk about regularly, is that you want to diversify on a number of levels. So we're going to talk about this next week in another show, when we're going to really focus on mitigating risk. And diversification is the key way to mitigate any risk. So we're going to talk about systemic or systematic risk, which is market-wide, operational risk, which is an individual advisor, an individual fund manager helping you run your money, and the risks that come along with having all your eggs in one basket from that perspective. And finally, the question of security-specific risk, which is, if you can be the best stock picker in the world, but if you pick one stock that goes the wrong way, you have a big risk there. So that's why typically you would try to achieve diversification on all those levels. First of all, at the asset class level, you want to have the traditional ones of stocks and bonds, and then throw in some alternatives in real estate or debt or mortgages, for example. And then at the next level, you want diversification among securities, which is why people typically buy mutual funds or invest in investment funds instead of into specific securities. And then at the final level, if you are going to buy individual securities, you're certainly going to try and buy 2 or 3 instead of just one, because it comes back to the eggs in the basket challenge.
David, always great talking to you.
It's a pleasure.
We're out of time on alternative investing. You know what time the show is. 11:30 Eastern on Fridays, 8:30 Pacific. Have a great weekend, everybody.